Listen up. Tax season 2026 just kicked off, and Tax and Borders has a real question for you.
Are you sitting there as a senior thinking that just because you've retired or you're retiring this year, you're safe to file your 2025 return early in 2026? You think you're flying under the radar? Big mistake. Most seniors are rushing into the new senior deduction lines without a plan. Between IRS system glitches and one specific filing error on that form, you're not getting a refund, you're getting a manual freeze. The One Big Beautiful Bill Act is not your only headache, because watchdogs already warned reduced staff and carryover inventory can slow processing. In this video, we break down the OBBB changes, the return impacts, the document stack, the due dates, the paper traps, 5 mistakes, and the IRS bottleneck.
We're laying out all the problems today, plus my real opinion on the IRS at the end.
Most people file Form 1040, but if you are age 65 or older, you may choose Form 1040 SR as an optional alternative. That choice does not change the math because 1040 and 1040 SR use the same schedules and instructions.
Look, right here in this Form 1040R, there's a big time mistake you're going to make. It's called Schedule 1A. Stick with me, because we're going to break that down in a bit.
Your simplicity is not defined by being retired, because it is defined by whether your documents match what payers sent to the IRS. If you have Social Security, pensions, dividends, interest, rentals, or capital gains, your risk comes from mismatches, not complexity. And the federal return is only half the battle because many states still require their own return based on residency and income sources. Even if you moved during tax year 2025, a part-year state return can still chase wages, distributions, rentals, or home sale gains. If you had W-2 wages, you are not just a retiree, because withholding and wage matching are core triggers for verification.
Listen, that big change in 2026, it's coming us straight from the One Big Beautiful Bill Act. Let's talk about it right now, all right?
OBBB raised the standard deduction for tax year 2025, meaning the return you file in 2026 uses new baseline numbers. Now the consequence begins. Claiming new OBBB items can push your return into manual review if the IRS systems cannot match your figures. For tax year 2025, the standard deduction is $15,750 for single and $31,500 for married filing jointly. For head of household, the standard deduction is $23,625. Here's the part most seniors miss. There is a real extra senior deduction in tax year 2025 and beyond. If you are age 65 or older, you may qualify for an extra $6,000 deduction, or $12,000 if both spouses qualify. This deduction is temporary. It applies to tax years 2025 through 2028. Then it disappears unless Congress extends it. That deduction stacks on top of the regular standard deduction rules, so it can reduce your taxable income fast if you qualify. But it phases out as your income rises, so higher income seniors may see a reduced deduction or no deduction at all. Pay attention, you must claim it on Schedule 1A attached to your Form 1040 or Form 1040 SR. Do not assume your software will apply it automatically. Verify that Schedule 1A is generated and review the final return before you hit file. Lower taxable income can also support planning because Medicare surcharges use a 2-year look-back, so today's choices can echo later. That is why bigger refund talk is dangerous, because your refund is not real until your return clears matching and any identity review. Also note OBBB created new deductions for tips, overtime, and certain car loan interest, and those claims increase mismatch exposure. Here is the trap. The more new items you claim, the more chances you create for a letter, a hold, or verification. And in a season with fewer staff, anything requiring a human becomes slower, because you are competing for fewer hands.
Next up, return impacts. This is where people file too early and buy themselves months of delay.
Early filing can beat your own documents. W-2 and 1099 forms arrive in waves, and missing data increases mismatch risk. When processing hits an error, the IRS can route your return into ERS, where human review replaces automation and time slows. If the IRS can't verify you, refunds can freeze, and Letter 5071C may require online or in-person verification. Once a human touches your file, identity, ERS, or a math error correction, everything shifts to notices, deadlines, and mail cycles. Don't volunteer for the bottleneck. Wait until your key forms are final, then e-file and use direct deposit. Translation: do not give the system reasons to touch your file because touched files move slower when capacity is strained.
Next is paperwork. Retirees got different forms, and the IRS matches them line by line. Be precise.
Start with last year's return and prior year IGI because tax software uses it for identity verification and e-file authentication. Keep every IRS letter because notice numbers and reference codes determine who owns your case if something goes wrong. If you had wages, collect every W-2 and verify withholding boxes because payroll errors create prove-it holds. If you had consulting or side work, gather 1099 NEC or 1099 MIC and keep an expense ledger. The IRS sees gross income on payer forms, not your net profit, so your ledger is the defense when questions arrive. If you receive Social Security, your SSA 1099 is essential, and Medicare withholding affects the taxable benefit calculation. If you receive pensions or IRA distributions, collect every 1099-R and confirm rollover codes, taxable amounts, and withholding entries. If you have dividends and interest, wait for 1099 div and 1099 int, including reinvested amounts you never touched. If you sold securities, you need 1099B plus consolidated broker statements, and you need cost basis support when basis is missing. When basis is wrong or missing, you can pay tax on money you never earned, because the IRS can assume basis is zero. If you own rentals, you need a rent roll, repair receipts, property taxes, insurance records, and depreciation schedules for audit-proof reporting. If you pay rent, remember renter credits are state issues, and some states require a rent certificate or landlord documentation. If you sold a home, keep the closing disclosure and improvement records because the gain exclusion depends on dates, use tests, and basis math. If you made estimated payments, keep confirmations because missing one entry can create a fake balance due and trigger penalties. If you touched digital assets, do not treat reporting like a simple 1099 because basis reporting is still messy across platforms. Certain digital asset statements can arrive mid-February, and filing before they arrive can force an amended return later. Amended returns are the slow lane because they require manual handling and can sit while other inventory keeps piling up.
Do not blow these deadlines. The penalties are sky high, and the nightmare that follows will make you wish you'd never started. Don't say I didn't warn ya.
The filing deadline is April 15th, 2026, but corrected broker statements often arrive in late February or March. Extensions give filing time, not payment time, so you must estimate and pay correctly even if you file later.
Still mailing paper? That's a one-way ticket to a processing nightmare. Between the backlogs and the risk of it getting lost, you're just wasting time. Get modern.
Paper returns take longer than e-filed returns because paper must be routed, scanned, and often corrected by humans. Paper refund checks also take longer and add theft risk because stolen mail turns your refund into an identity case. Mailing also creates postmark risk because "I dropped it in the box" is weak evidence if deadlines get disputed. So paper is not neutral in 2026, and it is not safer when the system is strained and fraud risk is real. Now, 5 common mistakes that cost months because the biggest loss is time, and time is money when cash flow is tight. Mistake 1 is filing before every form is in hand, then amending, then waiting behind everyone else in the backlog lane. Mistake 2 is claiming new OBBB deductions without clean eligibility proof, then triggering a verification hold you cannot talk away. Mistake 3 is assuming retired means simple while you still have RMDs, dividends, rentals, and investment sales. Mistake 4 is choosing paper filing or paper refunds, which slows processing and expands the window for fraud. Mistake 5 is skipping identity defenses, then discovering someone filed first, turning your return into a victim case. Your strategy should be aggressive and boring. Complete matching, controlled identity, e-file, and direct deposit every time. Now the IRS problems in 2026 because your risk is shaped by capacity and automation, not by good intentions. This season is harder because the IRS is implementing many complex OBBB changes, and every new rule increases mismatch probability. TIG-TA warned that unworked inventory carries forward into filing season and slows refunds, especially when returns fall into manual lanes. TIGTA also documented a steep workforce decline, roughly a quarter lower than early 2025 levels, reducing processing capacity. When a return leaves the automated path and hits error resolution, it waits for humans, and humans are the bottleneck. That is why small issues like missing forms, corrected statements, or withholding mismatches can turn a refund into months.
Look, this whole IRS situation, it's a joke. Let's be real, this is what happens when you have zero planning. We got all these radical orders flying around, major changes happening overnight, and absolutely nobody was prepared. And guess who's paying for this circus? You are. Directly, indirectly, it's coming out of your pocket. If the IRS is late, you pay. If you are late, you pay even more. Think about that and talk to me in the comments. Don't forget to hit like and subscribe. And watch these videos right here. They're hitting your paycheck where it hurts. Don't say I didn't warn you.
This content is for education only and not professional tax advice. Every situation is different. Always verify with a tax expert before applying the senior deduction to your 2025 return.